Hello, this is the Unemployed Value Degen. I am not giving financial advice, and wow, what a week it's been. Maybe before we look at the 10-year Treasury, take a look at the S&P 500, and Friday especially. I mean, look at that red candle on Friday. Let's see. Yeah, that was quite a one-day drop. And what's interesting about that is the last 4 weeks, Fridays have been green, right? So this last Friday was a huge red sell-off. There's been a bit of a pattern that on Fridays, people want to get out of the market and avoid geopolitical risk. What's really interesting is if you look back, you've got a green Friday, a green Friday, a green Friday, and this huge red Friday. So for the last month, it seems like during the week, Trump will tweet something that'll cause the markets to sell off, increases uncertainty. And then by the time we get to Friday, it feels like the market's oversold and people are buying on a Friday despite geopolitical risk over the weekend. You know, is Israel going to bomb Iran? Are the Houthis going to blow up some ships over the weekend? So the people sell on a Friday to avoid that geopolitical risk for 72 hours or so. But this last week, you know, the market rallied somewhat on Monday and Tuesday, and then the Friday sell-off was just enormous. That was a painful day. And I think more importantly is after this 10% drawdown, this 10% correction, getting rejected at the 200-day moving average is a little troubling. Right? We'd broken over the 200-day moving average and then came crashing right down below it. And the NASDAQ was even more pronounced because the NASDAQ was a perfect bounce off of the 200-day moving average and a dramatic crash, almost back to a lower low. Not quite back to a lower low, but tech is really leading the sell-off aggressively. There's the MAG 7 ETF, right? And again, just rejected right off the 200-day moving average. The equal weighted S&P 500 is holding up a lot better, right? So the equal weighted S&P 500 is much more stable. It's a tech-led sell-off. I think that's what we're going through right now. But the equal weighted, even there, the last peak was end of November, early December. And then small caps, the most painful place to be in, that has just trades with the worst of everything. It just doesn't even matter which sector you're in. Small caps are trading with the tech sell-off and a really aggressive drawdown. This one didn't even come close to the 200-day moving average. And for the Russell 2000, we're back below this long resistance line. Right? Was it give or take here? Wherever you want to draw this line that past resistance becomes future support. We've broken way down below that and didn't even come close to the 200-day moving average. It's just a rough time for small caps. It's not always going to be the case that small caps underperform. In fact, the theory is that they're going to be more sensitive to falling interest rates because their debt is shorter term, and they should be beneficiaries of the trade war because they have less international exposure. So they should be doing all right, but I think you know, when everybody sells off, just the higher beta names go down and small caps are higher beta. But let's go back to where I usually start, which is the 10-year Treasury. In the 10-year Treasury, it had even crept up on Thursday to 4.35, and people are wondering if the 10-year Treasury is going to start creeping up, which is interesting because Donald Trump wants a lower 10-year Treasury. Scott Bessent wants a lower 10-year Treasury. And you'd normally think that if there genuinely is recession fears, if people are afraid that this tariffs are going to plunge us into a recession, well, you would think that that would lower interest rates. And it's not doing it, right? So having the tariff fears, having the 10-year rising into tariff fears is a little interesting because if tariffs are going to plunge us into a recession, again, you'd expect people to buy more treasuries and interest rates to fall. And that's not what we're seeing happening. One of the things that spooked the market, I believe it was Wednesday or Thursday, is the University of Michigan inflation expectation survey came out. And the partisanship of it became even more extreme. The average Republican expected for the next year for there to be 0.1% inflation, and the average Democrat expected there to be 6.5% inflation. So people have their inflation expectations completely detached from what I think is a more likely scenario. And it's just people have their news sources, and the left-wing media outlets tell them, you know, tariffs are going to be extremely inflationary. And then the conservative news media outlets tell people that, you know, Trump is a golden child and he'll have this miraculous negotiation and there won't be any inflation. I mean, I think both are wrong. 0.1% inflation, and I'll bring up the Truflation measure. So I think both sides are wrong for that, but every time you average 0.1 and 6.5, and they oversample Democrats, so they're showing something like 4% expected inflation on average. Meanwhile, the Truflation, the goods and services, when people are going and shopping at the grocery store, in Truflation is measuring under 2%, which is the Fed's target. So, this is contemporaneous. This is a current index. So if people were buying aggressively to front run the tariffs, this would already be in there. And the big difference between Truflation and CPI is just the smoothing out the cost of housing. So the cost of housing in CPI is smoothed out over the next several years, where in Truflation, this is all, you know, SKUs that are purchased at stores. I think it's 10,000 something SKUs. And it's a much more instant number. They both have their pros and cons, but where inflation is and where it's likely to be for the next year is totally, you know, unanchored from these hyper-partisan internet surveys from the University of Michigan. And when that happens, so you saw the 10-year Treasury, you know, jump up almost 1/8% just on that survey, and then come crashing back down on Friday. You know, we're down from the peak. We're not close to 4 3/4 anymore. You know, Scott Bessent and Donald Trump have a strong interest in getting the 10-year Treasury low so that they can term out some of this debt and save $200 or $300 billion a year on interest expense. $200 or $300 billion a year on interest expense is real money. That's some real savings. If you're gonna come close to shaving $1 trillion off of the deficit, a couple $100 billion of that probably has to come off of interest expense. And so this seems like it's, you know, priority number one. Now that I think Trump's first priority was fentanyl on the border, and he, you know, logged some quick victories in the conservative news media for those. And now the number one priority is tariffs and getting the 10-year Treasury down. And well, it looks like we're still in the downtrend, right? To me, this looks like where are we going? To me, it looks like we're still, hold on. We're still kind of probably heading down. I don't know. This would put us maybe at a 3.5% 10-year Treasury this summer. That would be fast if we could get there. 3.5% 10-year Treasury by this summer would really do a lot to goose the housing market. We'll have to see. That would be pretty exciting. I don't know if that's what's going to happen. And then the dollar index. Right, the dollar index is not rocketing back upwards. So let me go ahead and, I had been drawing a channel. Let's see, where do I want to draw this channel? Somewhere like that. Be more horizontal one. So I don't know if we're going to be bouncing around inside this horizontal channel. But the dollar is off of its strong point. So I think this happened in the first Trump presidency. The dollar strengthened into inauguration, and then it sold off afterwards. The argument is that Trump is a mercantilist. He wants to boost exports and weaken the US dollar. And will he be able to get it? I'm not sure he's going to be able to get a dollar as weak as... Trump hasn't said he wants a weak dollar, but politicians can't really say that and maintain popularity. But there are some hedge fund managers out there saying that, you know, Trump is going to bring us into maybe a... let's see, go back in time some. You know, maybe a dollar index below 90, right? That maybe Trump wants a dollar index below 90. How far back do we have to go? Where was the dollar in Trump's first term? So 2016, yeah, so this is where, so Trump came in 2016, or did he come in 2017, 18, 19, 20? All right, so Trump comes in, you know, January 2017, and the dollar falls from, you know, over 100 down to about 90. But there are some talking heads out there saying, you know, they between this $80 to 90 on the dollar index range. If Trump was a mercantilist, that's where he would want to be, right? Somewhere between 80 and 90. Meanwhile, we've been in this channel that's somewhere between, you know, 101 to 108. So this is where we are. This is where the real dollar bears say we're going to be. It's just so hard when Europe is, Germany just announced, I think, 1.7 trillion euros in new spending. And their, you know, bond yields, their interest rates are rising. So they're going this easy money program in Germany. We have cheap electricity in the US. Between cheap electricity and Europe's economy struggling, I don't know. But the dollar bears think that we're going to re-enter this 80 to 90 range on the DXY. I'm not convinced. I'm not convinced. The voting public in Trump's base were so riled up by inflation that to weaken the dollar and to have foreign goods prices go up so much, to have that rising price level from imports, well, I know he is doing the tariff war. I think that would cost him a lot with his base, but I'm not sure. It's just very hard in a world where you have cheap electricity and you have higher interest rates than everyone else for your currency to weaken. The fear and greed index, we're still in extreme fear. Right? We're still in extreme fear. And we just, for a couple of days, we got out of the extreme fear area, and then Friday we came crashing back down into it. And then let's look at the VIX. Right, so market volatility, you know, the VIX had fallen below 20, and then on Friday it spiked back above 20 again. And I mentioned before in the last video, this is the first 10% correction in the S&P 500 ever where the VIX didn't spike above 30. And the bears, I think the market's going to keep crashing, say, oh, you know, you're going to see a VIX above 30 during this crash. That Friday sell-off was pretty rough, right? That Friday sell-off was pretty extreme. But that's the Friday before Trump's April 2nd Liberation Day. I think we're kind of running out of uncertainty. You know, we're running out of reasons to run away from the market. If anything, you know, over the next week, there's got to be things that happen that remove some of that uncertainty. You know, are we going to have a trade deal with, I mean, even just one country, even just the trade deal with Mexico to remove some uncertainty for the market so people can get some visibility and say, okay, what is Trump trying to accomplish? What kind of things is he going to put into place? If you get some sort of a resolution with even one country in the entire world so that people see what Trump is actually trying to accomplish, I think it's hard to have big sell-offs like that if uncertainty is being resolved. You know, junk bonds are still subdued. And then the counter argument to that is all the really junky junk debt is in private credit, so we don't really have a good gauge on how bad the junk debt is. I think what's more likely is that nominally, right, we increased the money supply so much during COVID that all that legacy debt is just easier to repay. All these companies have an easier time sustaining that old debt because prices are now 40% higher across the board. So people are buying, they're buying puts and calls, right? Options volume is high. And then I never know how much of that is 0 days to expiration and how much of that is longer dated. You know, price breadth is bad, price strength is bad, but it's a correction. We're in a 10% correction. And then the style box, right? For the last 3 months, people have been moving into large value. Actually, let me leave that behind and go to the, take a look at this S&P 500 sectors. So this is year to date, the S&P 500 sectors. You have consumer discretionary down 12, technology down 11. But if you were equal weight by sector, you're doing all right this year. Right? You've got energy up almost 8%, you know, staples up, financials up, healthcare up 5, materials, real estate, and utilities. Of the 2 that are down, or 4 that are down, communication services and industrials, you're only down by a percentage point. If you were equal weight by sector, you're kind of doing okay this year. And if I look at that by this dispersion, right? So coming in January, you had tax loss harvesting before the end of the year, and then people buying back into the stuff that they sold. And energy was the big winner. So energy was the top performing sector right before the inauguration. It was up 9%. And then after the inauguration, you start having the market sell off, right? But that's really accelerated now with tech. By the time you get to February 10th, tech was the worst performing sector of the year, and then it just keeps on going lower. And so now we've got tech and consumer discretionary each down 11 or 12%, and that is pretty brutal. But most of the sectors are doing okay, and you've got energy now. Again, it's almost back up to positive 8% for the year. Not in small caps, not in the garbage that I bought, but mostly in the large caps. And if you look at, let's see, this one. So this is, right, just because, you know, the sectors that are down by market cap weight, right? So technology is down the most, and it's enormous. Consumer defensive is a smaller sector, but it's really so much of the market is technology. Consumer cyclical is not huge. Communications is kind of flat, right? Because, you know, some of the smaller ones are up. And then the things that are doing well, you know, energy, healthcare, materials, utilities, they're just so small. And then in materials, let me go to the full, right? This bright green box right here in materials is gold, outperforming everything this year. You have, you know, even the large names are up 30%, but some of the smaller names, here you've got, let's see, which one is this? So DRDGold, which is half owned by Sibanye Stillwater, is up 71% year to date. That's just incredible. EQX is up 36% year to date. There's a lot of names here just going crazy. Well, because the price of gold is going crazy. But that really is a bright green spot. And then when you have something like energy, right, which is a relatively small sector, but it's still responsible for such a large percentage of the earnings of the S&P 500. If you look at the price to earnings ratio of energy, you know, it's still really beaten down. So if financial advisors tell their clients that the only way to get uncorrelated returns now is to look at these two sectors, energy and gold, they could have enormous fund flows. If you've got a year where tech is down 10-15% and gold is up 30%, 40%, 50%, what percentage of your portfolio should you have in gold and energy to try and get those uncorrelated returns? That conversation between financial advisors and investors hasn't happened yet, because everybody's in the 60-40, 60% stocks, 40% bonds, because the bonds are supposed to give you that negative correlation. But the stock-bond relationship flipped positive. And since the stock-bond relationship flipped positive, What I'm waiting for is, when do financial advisors tell retail investors that they need to own 1 or 2 or 3% gold in their portfolio, or 2, 3, 4% energy in their portfolio? When is that rotation going to happen? Because that process, that's like a 10-year process. So there's a real possibility of heading toward a world where gold and energy, outperform for the next 5 or 10 years, as the allocation goes from, I think retail investors, it's like 0.5% in gold. And if that gets to 1 or 2% over the course of the next 10 years, this is just an explosive bull market for gold and gold miners. And the big competition for that is cryptocurrencies. But with energy, so that the two things that can be negatively correlated with stocks is going to be energy and gold. Gold has that competition with cryptocurrency, but energy doesn't. So energy has the that ESG drag on it, that people don't want to buy it because it's dirty and it's evil. But that narrative is kind of changing. And with energy as the top performing sector for the year of the major sectors, I wonder how long it's going to take before the momentum chasers start piling in. It's going to depend what's going to bounce the hardest on the way up. Because there's a chance, right, if we go back to this, right, if we go back to the graph where things are this year, if you're some sort of algorithmic trader, if you're a momentum chaser, and you see, the value investor says, hey, maybe we should buy tech, it's down 11, 12%. But the momentum investor, the technical analyst, says, well, hey, energy's up 8%, maybe they'll keep going. Are we going to have a world, so when the S&P 500, when it starts bouncing and climbing out of this drawdown, whether it's here or whether it's another 5% lower, I have no idea. When it starts climbing out of this, what's going to lead, right? Is the Magnificent Seven going to lead us out of this? Or is energy and healthcare and materials and real estate and financials? I don't know. It's going to be really interesting to see how that plays out, because the NASDAQ is not looking so hot. The NASDAQ is in a pretty serious drawdown, and it's not close to a death cross yet, because the way up was so aggressive, right? We've still got, at this rate, probably 2 or 3 months before there'd be a death cross. I don't think this drawdown is going to last another 2 or 3 months. That's just me. The Mag 7, still another couple of months before there would be a death cross. The Russell 2000 is already there. The Russell 2000 had its death cross. Oh, small caps are just so painful. When they outperform, they're going to be fantastic. Small caps have this pattern where they underperform for 15 to 20 years, and then they outperform for a year. But when they outperform for a year, it's because the price of everything triples. So it's if you look back on the history of the stock market, since World War II, you have on average small caps outperforming by about 2 percentage points a year, but it comes in a really chunky fashion, right? It underperforms for 15 to 20 years, then it outperforms for 1 or 2 years. But when it outperforms, it outperforms by a lot. And if it's the bigger the base, the bigger the breakout. This has been forming a base since January of 2021, and now we're in March, April of 2025. So this is a 4-year base. So when it finally breaks out, well, it should be quite the breakout at that point. All right. So on the way out of this, what's going to lead us out of this drawdown? Is it going to be tech, or is it going to be energy? Is it going to be, it's probably not going to be consumer discretionary, right? But go back to this heat map. What's going to lead us out? Is it going to be materials, right? We were promised the commodity supercycle a few years ago. Are energy and materials finally going to lead us out of this? Utilities have had quite a run. And they're very interest rate sensitive. So as the interest rate falls, they could do all right. It's a small sector. Real estate has been pretty beaten down. So which sector is going to lead us out of this drawdown? I think I might have been early on consumer cyclical. I think consumer cyclical, You might need the real economy to bounce back before people start opening up to spending again. Although the counter argument to that is all you need are interest rates to fall enough. And then people will start taking out some home equity loans and spending that like crazy. Communication services. I mean, is it going to be the Mag 7 that leads us out of this, or is the sell-off in the Mag 7 going to continue? And you know, there's a good chance it could be financials, healthcare, materials, energy, industrials that lead us out of this. Could be. I mean, that would be what my portfolio is positioned for. My portfolio has not had a great run of things for the last 2 years. Or, you know, do we wake up on Tuesday and say, hey, you know, we were totally wrong. The AI revolution is still ongoing, and Nvidia is the thing that you need to buy. Let me look at this Nvidia chart. Is there anything positive looking on this Nvidia chart? It's not even the most aggressive sell-off. You do have a death cross on Nvidia. Yeah, look at that 5-year run from the low in October of 2022 at what is this? At about 12, all the way up to 140, and then back down to 110. Yeah, this chart's logarithmic. Not my favorite way to view it. Yeah. I mean, in the short term, it could sell off some more. The RSI is falling and it's not quite oversold yet. Although for the last year, the RSI hasn't hit 30. So the dip buyers tend to come in on Nvidia before it gets to oversold. It's amazing. It hasn't been oversold at all in the last year. But the MACD is falling down. I can move this to Bollinger Bands. It's getting close to the lower Bollinger Band. I think that crowds it. I might go back to simple moving average. I like to keep an eye on the 20-day moving average. Yeah. I think Nvidia could sell off another couple of days. I don't have an opinion here. I'm not going to try and call the bottom on Nvidia. That's too rich for me. But the one stock that I have that's exposed to the artificial intelligence revolution is Applied Optoelectronics, and that has had, you know, this is quite a pattern now, right? For a while, I was saying that this looks like a bull flag, right? And that's what you would expect from a bull flag, and then from there you would expect it to go off to the races, and it didn't, right? It broke down instead, but then it caught, you know, quite a good bounce. I don't know what's going on here. They just signed a huge contract with Amazon. It gave Amazon warrants as they fulfill $4 billion of purchasing of Applied Optoelectronics equipment. This is an $800 million market cap company, and they just landed a relationship with Amazon where Amazon can gain warrants in Applied Optoelectronics as they take up $4 billion worth of purchases of this company over the years for the data center build-outs. Again, they make these little connecting pieces of hardware. So when the fiber optic cable has to connect to a computer, there's some little piece of hardware that turns that fiber optic cable back into something readable by the machine again. So they have all these connectors and junctions for fiber optic cable at Applied Opto. And they have relationships with it. When I did my write-up on it, it was 3 out of the 5 major hyperscalers. If they have that relationship now with Amazon, that would be 4 out of 5. So they have purchase orders from 4 of the 5 major hyperscalers. I think they do have competition, but their management team argues that they have a technology advantage. So positive fundamental results, and the stock price keeps falling. What are you going to do? That's Applied Opto. I'll look at my 3 silver tsunami stocks. Look at this candle on Abacus Life. This is just an amazing candle. So Abacus Life announced earnings on that Friday with the massive sell-off. So, and their earnings, Abacus Life grew revenue by something like 58% year over year. They grew net income by 70% year over year. They guided for next year to grow revenue and earnings by between 50 and 60%. So this company has 50 or 60% growth for last year. They're guiding towards 50 or 60% growth for next year. On that earnings announcement, it tried to break out, tried to come close to its 200-day moving average. But just the sell-off pressure of the day, that Friday with the geopolitical risk ahead of that April 2nd, Trump was calling it Liberation Day, it sold almost all the way back down to where it opened. That's quite a candlestick. I got to zoom in on that. You don't often see a candlestick quite like that. It's like one of these things is not like the other. So this was an amazingly positive earnings announcement. Just everything good, nothing bad. Amazingly positive earnings announcement that hit just about on the worst possible day of the year. So it actually, the earnings announcement was the night before, so 5 o'clock in the afternoon on Thursday, and the market opened on Friday with so much enthusiasm for this thing to be up, by $1 a share. It was up, 11, 12%. And over the course of the sell-off in that day, it just came crashing back down. But this is still a company that is growing at 50 or 60% a year. They're the only public company in their space. They have an enormous head start. They did do a couple dilutive acquisitions, and now they're doing share buybacks to try and retire the shares that they used for the acquisitions. But so much growth is priced in that the buybacks are kind of modest. But they're going to grow 50 or 60%. So if the PE ratio stayed the same between now and next year, they should have 50 to 60% growth just on revenue growth. And I think it's due for some multiple expansion. And the market was trying so hard, and it just couldn't do it. Sometimes, no matter how good the news is, if it hits on the wrong day. But I'm going to be curious to see that if there's any recovery next week, this stock wants to break out. It's just, you don't see a candle like that all the time. That's amazing. That's Abacus Life, Finance of America Companies. Right, this is that earnings call that I had anticipated. I said, you know what, this earnings call could be a bad one. I want to see how the market handles it, and it gained it all back. Right, the algorithms didn't like the gap accounting, but when human beings looked at the adjusted accounting, it was fine. So it's still in the consolidation period. This is much more of a bull flag. This is right. So this is much more of a bull flag. The consolidation period is maybe longer than I would like, but a very reasonable bull flag, as opposed to Applied Optoelectronics. Applied Optoelectronics, I think it would be a bull flag if the entire sector for the data center build out wasn't getting totally crushed. But so Finance of America Companies, still consolidating. I'm very happy that on the last earnings call, which had some tailwinds from rising interest rates, or had some headwinds from rising interest rates, but next quarter that's going to be tailwinds from falling interest rates. So next quarter should be amazing for Finance of America Companies. And then the third of my silver tsunami stocks, Jackson Financial. Yeah, same. Let me go back to 2 years for this. This is maybe a longer bull flag, right? Because this had a huge run up from 35 up to 110, and again, almost the same graph, just a massive run up, a bull flag, consolidation period, and then it'll break out again. I don't know when. I'm very surprised that such a high quality company would sell off from 110 down to 78, right? That was a surprise. That drawdown was so sharp for me. But these last right, so small caps had their peak in November. Outside of that, just this whole January, everything post-Trump, everything with the tariff fears after inauguration, it's held in there pretty well compared to a lot of other stocks. Going from 95 to 83 during this drawdown period for small caps. It's holding up pretty well. Those are my silver tsunami stocks. Energy. So energy is a sector in the S&P 500 is up almost 8% for the year, but not in small cap. So there's, I mean, New Fortress Energy, the drama continues, right? Sold off from 16 down to, you know, intraday down into the 7s, climbed its way back up to 12, and then rejected again back all the way down into the 8s again. So New Fortress Energy announced the sale of their Jamaica facility. And I think in my write-up I'd estimated between 1.2 billion and maybe 1.8 billion. And they sold it for a little over 1 billion, like 1,050 million, something like that. Which was about 100 million less than I thought they'd sell it for. But it's still debt retirement. I think it's still the right thing. And the EBITDA they lose from that, the Nicaragua facility is coming online, and that's also the same, about $125 million in EBITDA. So their EBITDA is pretty much flat. They get to retire $1 billion worth of debt. The market hated it, and the ratings agencies, even retiring $1 billion of debt, the ratings agencies that had just cut their debt rating didn't increase it again. So it's a bit of a bizarre situation. I think the next catalyst is going to be some news event out of Puerto Rico, because they had given up a year remaining of their service contract for Puerto Rico. And I think what you're going to see is Puerto Rico wants a 10 or 15-year contract. So they're going to lock in some prices in Puerto Rico for the next 10 or 15 years, and maybe even have a couple of power plant conversions from diesel, heavy oil to natural gas. I mean, and that can happen quick. So if they're going to upgrade guidance by a couple $100 million of EBITDA for, you know, for the next 12 months, and the stock is heavily shorted. I can check the short interest, but I would have a hard time seeing the stock price, you know, unable to start climbing out of this mess. Let me check out the short interest on New Fortress Energy, because I have started seeing some things on Twitter where you can tell a stock is getting heavily shorted because people start lying about it. Yes, it's about 20, 21, 22% short interest. The days, so the volume is so good that's only about 7.5 days to cover. But 20% short interest is enough where you start seeing people come out on Twitter just telling lies about the company. You know, one in particular, so management guided toward retiring $2 billion of debt through asset sales. And they said, oh, you know, they said Jamaica was going to be worth $2 billion, which is not true. They never said Jamaica was worth $2 billion. They said they were going to do asset sales to try and raise $2 billion. That, you know, that was not an estimate for how much Jamaica was worth. So again, I start seeing lies coming out about a company, then I know it's heavily shorted. Wondering where Medical Properties Trust is coming in right now. Yeah, Medical Properties Trust, the short interest has come down from 45% to 35% and about 13 days to cover. I'm surprised that the short interest was able to fall so much on you know, a relatively slow price increase. I really expected for there to be some aggressive squeezes, but they still have 35% of the float sold short. And this, I don't know if that takes into account, there's, let's see, out of the, so there's a 500 million share float out of 600 million, so there's 100 million shares locked up. And the short interest, yeah, 176 million shares are shorted out of the 500 million available. That is a lot of short interest. Anyway, back to the energy space. So New Fortress Energy, this is just an amazing amount of drama. I thought it was going to be climbing out of this mess and it just gets smacked back down on what I thought was good news. Look at Vermilion Energy. And Vermilion Energy, now this one's climbing off of its lows, and what's interesting is this last week when everything sold off so hard, Vermilion was pretty well behaved. So energy is holding up somewhat well. Profrac Holdings,
You know, still a big fat red candle on Friday when everything sold off, but ProFrac Holdings been climbing out of this mess in March. It's been in the $8 range, back into $7.70. The rig count and the frac fleet count still are not bouncing back very quickly. They're still being very subdued. You've got this collision between Trump's, you know, drill baby drill to bring oil prices down, but then you're also going to, you know, sanction the Russian tankers and the, you know, cut off Iranian exports and cut off Venezuelan exports. I think the oil price is going to have to go higher, and when the oil price goes higher, these frac fleets and the rig counts are going to have to rise again, and the price are going to have to rise again. But the oil price hasn't been high enough to do that yet. But I think it's coming. I think energy, I was a couple years early. I think energy, it's getting to be time for it. The offshore, how is offshore doing? It's, you know, it's been a bumpy ride, but it's off of that bottom from the beginning of March. I still can't believe it saw $2.50 again, but it's climbing out of it. When you have a correction, you typically have, I think I said this last time, the converse of that they come for the generals last is that the small risky stuff is already well into its recovery before the major index hits its last, the bottom of its trough. So even though the S&P 500 is falling, even though the NASDAQ is falling, a lot of stocks that hit their lows are already climbing back out of it. So Transocean is climbing out of its low. Another one would be Peabody Energy. So Peabody Energy sold off to the 12s, and it climbed up back to the 14s, back into 13 now, but it's off of the lows. So again, this is the converse of they come for the generals last, which is the small stuff sells off hard first. But the small stuff, a lot of it, I think, has already hit the bottom and is climbing out. I would be genuinely surprised to see a lot of these small cap names break below these previous lows. I wouldn't be surprised if the NASDAQ kept selling off. I would be surprised if the small caps kept selling off. Because again, it's the converse of that they come for the generals last. Another one, Advance Auto Parts. So this one got a bit of an uplift when Trump announced tariffs on foreign cars. Say, oh, well, that means people are going to have to repair their domestic cars. Advance Auto Parts went from 37 to 42 in a day, and it's sold off again. Nowhere near the 32 it was the beginning of March. I think this, you know, March 1st, 2nd, 3rd, this first week of March is going to prove to be the lows for most individual small cap names. And again, we're climbing off of those lows now. Yeah, so Advance Auto Parts, there is a lot of companies with charts that look like this. And again, I think that's the converse of they come for the generals last. As far as which charts look good, you know, so Centrus Energy down here at 66, it's just touching the 200-day moving average. That's the make or break point where it either bounces off of that pretty well or it breaks down below it. Centrus Energy is one of my favorites. This is, you know, this is an inflection point. You have, you know, the MACD is possibly crossing over. You're almost at oversold on the RSI. You're touching the 200-day moving average. Centrus Energy has the potential for an explosive rebound off of this level or to break down further. ARS Pharmaceuticals, this is one where all the moving averages are compressing and coming together to make some sort of explosive move in one direction or another. For it to be so tightly, it's holding up really well. So let me zoom in on this one. Oh, I didn't want 3 years. I wanted 3 months. So here's the 200-day moving average. And there's a really positive thing here, because keep in mind, this whole week the market's been selling off. And even intraday when ARS Pharmaceutical falls below the 200 moving day average, people come back in and they bid it back up above it. To me, that's a very, very bullish phenomenon. For there to have so many days where you know, the sell-off, and remember Friday was that huge red candle and almost everything sold off on Friday, but not ARS Pharmaceuticals. So to have all this intraday moves attempting to get below the 200-day moving average and the dip buyers come in to buy this name back up, I think ARS Pharmaceuticals is prepared for, you know, an explosive upside. I think that's really bullish technicals. I'm not an expert on technicals, but that last 2 weeks of behavior for ARS Pharmaceuticals I find to be very encouraging in a world where everything was struggling, but this one's doing all right. One of my favorite industrials, Titan International. Titan International, you're well above the 200-day moving average. You've got the 50 and the 20 crossing. It's staying above the 50-day moving average. I think that's a pretty good. I think that, so there's a consolidation, so a bull run and consolidation. I think this could be getting ready for another leg higher, and for so many companies to have hit their low in March, I think this is a very, when you compare this to the overall market, I think this is a very bullish graph. Compare Titan International with the small cap, with the Russell 2000. Right, so you have a sell down from, you know, the end of November all the way down. So think of this in terms of relative strength. Look at the relative strength of Titan International during this time period. I think this is an incredibly bullish story. And this is one that I'm kicking myself for not buying more of. How is Portillo's doing? Yeah, Portillo's is coming back down to try and kiss its 200-day moving average again. For a lot of these small caps, I think next week is make or break time. You know, does it bounce off from here, or does it fall below the 200-day moving average again? So all these things, they're hitting areas where it's going to have probably an explosive move one way or another. Now this graphs that don't look so good. Heartland Express, this is new all-time lows. Oh, logistics is cannot catch a bit. I mean, it's doing a nice consolidation pattern. I don't know if this is going to be the bottom. But this is a nice consolidation pattern down here. It's Heartland Express. It's Custom Truck One Source. So Custom Truck One Source is again the relative strength here. So holding above the 200-day moving average, chopping and consolidating sideways, while small caps are getting crushed, while the Russell 2000's down 20%, for this to be chopping sideways and staying mostly above the 200-day moving average, which it's just on Friday crossed below it. I think Custom Truck One Source, out of the two equipment dealership businesses, this is the one that's more exposed to the power lines, to the grid strengthening. And I have a write-up coming out for Monday on the engineering firms. So both Alta Equipment Group and Custom Truck One Source, they both said that their customers are enthusiastic. They have a lot of contracts, there's a lot of things to do. And but Peter Bookvar was talking about how municipal government spending is going to be in the decline this year. That could drag down the whole economy. So I went to analyze, listen to the earnings calls of some of the engineering firms. And the engineering firm that is heavily exposed to this power line build out, their backlog is up organically 38% year over year. So they're saying, yeah, strengthening the grid, building power lines, our backlog for next year is up 38%. So this Custom Truck One Source, that's the equipment dealership for trucks specifically for power lines, this might be one of my stronger buy recommendations. So below the 200-day moving average, on a chart that looks like this, while the Russell 2000 is selling off so hard, I think it's a great time. Alta Equipment Group has more torque. Alta Equipment Group is more exposed to forklifts and road construction. That one really sold off hard. Alta Equipment Group has a lot more torque, but the engineering companies that are exposed to road construction, their backlog is up 11% organically. The ones that are exposed to power line construction, their backlog is up 38%. So I think Custom Truck One Source is a screaming buy right here. What else? SoFi. SoFi is the same bull flag pattern as before. You know, huge run up, consolidation. It came down to touch the 200-day moving average and bounced off of it. You know, it's a bullish chart. It's consolidation after a big bull run. There's a lot of scuttlebutt and conversation on Twitter now that Robinhood will be more serious competition. It hasn't affected their user growth yet. SoFi is still gaining a lot of new users. So until I see user growth slow down, I'm still going to like SoFi. What's been doing? The international stuff, how's PagSeguro doing? PagSeguro, it's below the 200-day moving average. I think I bought it somewhere here in the 7s. Yeah, it's making higher lows, and the US dollar is weakening. Let's see. Yeah, it's rough out there. I don't know what to tell you. Let's see. One last company to look at, Rocket Companies. That acquisition with the acquisition of, was it Redfin, for an all-stock transaction, I think is fantastic. It sold off a little bit on, go back to the 10-year Treasury. So the 10-year Treasury, I'll zoom into, so this period here from March 2nd to March 2nd to March 27th, right? So the 10-year Treasury is rising from the 2nd to the 27th. That's going to be bad for Rocket Companies. So March 2nd to the, so you have a little bit of sell-off here just in the last 2 weeks in March. It's been bouncing off of the 20-day moving average. It's just a little bit below the 200-day moving average. I still think this is a pretty bullish chart. It's making higher lows, right? So you have a higher low, higher low, higher low, higher low. I think that's a pretty bullish chart. I still like Rocket Companies here. So if I had to choose what to buy next week, you know, it might be Rocket Companies. It almost certainly would be Custom Truck One Source, ARS Pharmaceuticals. If you're into that huge inflection, maybe maybe Centrus Energy, and then the gold mining stocks. And I mentioned on gold that DRDGold was up 70% year to date, right? So there it is from the start of the year, coming $8.50 to $14.83. Keep in mind, Sibanye Stillwater owns half of this, so 1.28 billion is the market cap. Sibanye Stillwater owns 600 million of that, and Sibanye Stillwater is only 3.1 billion. So you're you got to take 600 million out of the market cap of Sibanye Stillwater for its ownership stake in DRDGold, and you're getting all of Sibanye Stillwater for 2.5 billion. So cheap. And it's been holding above its 200-day moving average. This is and it's consolidating, and it's not falling when the rest of the market is falling. Still a long ways away from a golden cross, but this is about to break some records for how much time it spends above the 200-day moving average. Right, so let's see. That's about a 2-month period. So there's not many periods. If you spend another week or two above its 200-day moving average, you're going to be breaking some records for the last 3 years as to how many days it spends above its 200-day moving average. I think that's extremely bullish. Glad I have something that's working. Yeah, it has been quite a sell-off. Go back to the S&P 500. Right. I had anticipated a bit of a V-shaped recovery, and I thought we were on it. I am surprised of the aggressive sell-off on Friday. I think that's a lot of people suddenly afraid of geopolitical risk. That Friday sell-off was I think very extreme. Next week, I think there's going to be some uncertainty removed from the market. I don't know what it is. If it's a trade deal with Mexico, I think Canada, they said they're not going to have a trade deal until after the election. They had a, Mark Carney had a phone call with Trump, and they said it was a good phone call, whatever that means. But they want to have their election in Canada first and then negotiate with Trump, which it makes sense. Europe is coming up with a list of concessions they're willing to make. As much as the media likes to spin it that Trump is some deranged nutball, the United States has lower tariffs than everybody else. Everybody else is making money off of the United States' exports. And the United States says, hey, that's unfair. So Europe, I think, is being rational adults and saying, okay, what can we lower our tariffs on? What can we come to an agreement on? Whereas Canada, I don't know, the press in Canada is drilling everybody up into a frenzy and saying, you know, Americans are evil and we hate them. You guys have a 300% tariff on dairy imports from the United States. That's not a friendly neighborhood thing. So, you know, equalizing those tariffs is, you know, we're talking about equalizing tariffs, and what's her name? Chrystia Freeland says, well, we're going to get nukes from the UK to defend against the United States. So you have a 300% tariff on milk. We want some sort of, you know, equalization, some sort of parity. And you say, well, we're going to get some nuclear weapons to defend ourselves from you. That's insane. These people are completely insane. But I think that whatever echo chamber is going on in Canada, they're not telling a side of the story that Canada has tariffs on the US, and the US has much lower tariffs on Canada, and the act of equalizing those is going to be devastating for the Canadian economy, because the Canadian economy has been weak since the global financial crisis. But they're not blaming themselves for voting in politicians that made the Canadian economy weak since the global financial crisis. They're blaming the orange man because, you know, orange man bad. I get it. I really do. I get orange man bad. But I think next week there's going to be some sort of removal of uncertainty. And when uncertainty is removed, I know the S&P 500's gone on price to earnings ratio. It's gone from something like 22 down to 20. It's taken a couple turns of PE ratio off, and that's entirely due to uncertainty. And when uncertainty is removed, then that PE ratio can come back. Whether that comes back fast or slow, I don't know. Are we going to keep on selling off next week? It's possible. This could have been a bull trap. I think it's much more damning when the NASDAQ completely rejected that 200-day moving average. Didn't spend any time above it at all. I think that's much more damning. But the NASDAQ is so big that as the NASDAQ sells off, it'll take the S&P 500 with it. Now the equal weight S&P 500, I think has much better chances of getting back above its 200-day moving average and being more into a bull market. So if anything is going to do well, I'd say it's the equal weight S&P 500. The Russell 2000 with its death cross, I don't know. That is an ugly chart, but it's a 4-year consolidation. Yeah, I think, and again, a lot of small caps look like this. A lot of small caps are bouncing off the bottom already. So there's Peabody Energy, Advance Auto Parts, and there was a bunch of them that way. I forget which ones, but Transocean, right? That March 1st, 2nd, 3rd, that seems to have been the bottom for a lot of small cap stocks, and they're already climbing their way out of it. And that's the converse of they come for the generals last. So the opposite of they come for the generals last is, you know, they come for the small high beta stuff first, and the small high beta stuff is already well into a recovery before the major indices like the S&P 500. Right? So the S&P 500 could still be bottoming, but that doesn't mean that the garbage that I own has to go down. Some of the garbage that I own might be climbing while the S&P 500 and the NASDAQ is still crashing. But we'll have to see what happens, but I think it'll be an interesting week. And what can I say? I want to buy some more custom truck one source. I don't own enough of this thing, and the price is very attractive. Anyway, thank you guys. Have a good day. This is the Unemployed Value Degen, and I am not giving financial advice.